All right. Well, good afternoon, everyone. This is David Grau, your host for today. Really excited to have everyone joining us today for our session titled "The Decade of Deals." The last decade, looking back to the early 2010, 2012 range, all the way to where we are today, there's been so many changes throughout our industry, and we get today to just kind of microscope, macro view or micro view on what's been happening with buying and selling financial service businesses, RIAs. Ton of changes over the last decade, a whole bunch here in just the last few years. Deal volume, there's been a lot of predictions, I think, over the last even 10 or 20 years since people have really started regularly buying and selling books of business, enterprises. So we're really excited to kind of hit pause here now. We're in 2020 and look back on the last decade, but with the main goal of then looking forward. What's in store for us in the next decade? Because I think between myself and our esteemed panelists that I'll introduce here ever so shortly, the next decade is going to be, I think, another record-breaking, kind of monumental 10-year run. And I'm excited to see what it has in store for us and see if our predictions, which we're going to talk about here today, end up holding true. So to kick things off, we've got our session here today led by myself, David Grau Jr., president of Succession Resource Group. We're a succession consulting firm dedicated to helping independent advisors value, buy, and sell their businesses. We kind of play in the billion in AUM space and under, but there's a lot of deals happening out there in the kind of larger RIA space with the billions of dollars in assets under management. And while we get a chance to read about it in the trade publications, one of our fantastic panelists here today, both of them, frankly, write about this subject, they study it, they talk about it at that larger size. So you're going to get really, I hope, a good cross-section of what's been happening and what's likely to happen across the entire space with buying and selling RIAs. So you got myself there on the left. You can follow us on social media. We put up LinkedIn, but as you might be aware, both Michael, David, and myself are all very active on various platforms. I think maybe everything except for Vine and some of these other more personal ones. So check us out on the various social media platforms. We're putting this stuff out all the time in terms of content. So joining us today, you've also got Michael Kitces, a prolific writer, speaker. Shortest way, he kicks ass, and he's great about keeping us all aware of what's happening in the industry. So again, we're going to take him from that macro view he's so good at to the micro view, what's happening with buying and selling these businesses, his thoughts and perspective. And then we've got David DeVoe, very well known. Again, another guy who puts out a ton of amazing content that, frankly, I read. And if I read it, you guys should know about it as well. So the three of us are going to provide perspective throughout the presentation here today. I'm going to kick things off, but you're going to hear from both of them throughout this session. I've got a couple of question marks here you'll see throughout the presentation. These are my kind of queued up questions that I want to ask the guys joining me here. But we're going to have a good, healthy dialogue throughout the presentation. And we're going to end by just kind of hitting pause on the presentation, talking about our predictions. What does the next 10 years look like? But as a quick recap, try to use our time as efficiently as possible today. We're going to talk about value, valuations, where we've been, where we're headed, because, the one thing I think we've all got in common listening in here today, from all over the country, we're in different lines of business, but the one thing we've all got in common is we're leaving this industry, horizontally or vertically. So it's in our future, and we want to try to provide you good tools, tips, information here today, and throughout the next 10 years, frankly, just to try to help you make more informed decisions. Your business is your baby. If you're involved in a business, trying to be a successor someday, this stuff is mission critical to know. So we're going to talk about what's been happening with value, valuations, deal volume. David DeVoe has prepared some fantastic slides to give you an idea of kind of what to expect in the coming years and what he's seen, most currently. Then we'll get into, like I said, the next decade and really just focus on where do we think we're headed? What's going to impact advisor value and valuations, deal volume. I think you're going to find this stuff hopefully really interesting and exciting. So I'm going to start out with a couple of interesting stats that we observed looking back over the last decade. First one is demand for practices. I don't think this is a surprise to anybody listening here today, but who knows, it might be. And that is, it is very much a seller's market. And again, I'm going to speak specifically from the perspective of the smaller independent RIA practices. So we're talking, under $1 billion in assets, and really kind of our sweet spot where we're going to have a lot of deal volume is the 500 million in AUM and below. Tons of deals happening in that space. A lot of activity on the buy side, which is what you're going to see here. 54 buyers for every seller. This is our current year. This is the 2019 data that we had aggregated. But honestly, even when you go back to the 2010, 2012, I think all the way through like 2013 or 14, I mean, you were still talking 20 or 30 buyers for every seller, which is, how many buyers do you ultimately end up needing? One. So even if you had a group of 30 and there's, let's say, 5 or 6 really good qualified ones in the mix, that's still 4 more than you technically probably need, but it makes it very much a competitive marketplace. So that has only continued to increase, up to where we are today. So as far as, my predictions are concerned, we'll talk more about this here in a few slides, but, kind of with the advent of bank financing available for financial advisors, which, the first half of this decade, it wasn't available. If you wanted to try to get a loan, you better beg and plead the seller to let you pay it out of cash flow. And they would do it because it was plan A and plan B, but it wasn't the most compelling thing for a seller to do on the way out, is to give you their book of business and let you pay them back with their cash flow. They would do it, but again, there wasn't a plan B. Now there's a plan B, and plan B quickly became plan A. As soon as buyers have access to capital, well, that was one of the things that kind of forced a lot of buyers to sit on the sideline. They didn't have 20 or 30% cash down for, let's say, $1 million book of business, and that's on the small side. So with bank financing now, and the fact that most or almost all buyers can get access to 100% of the financing they need for these small RIA acquisitions, there's more and more competition. So when you look at some of these aggregators out there, the Focuses of the world and their various offices, they're out there gobbling up practices. That's going to continue, but I would tell you, with more and more of these kind of mini aggregators, buyers that have done this once and twice, sometimes 3 and 4 times, they're savvy, they're small, they're nimble, and they've got the capital now thanks to the bank. So yeah, I think we're going to see over the next decade, volume of sales will certainly probably increase. Again, I'm curious to see what David DeVoe will share from his perspective. But at the smaller RIA level, there are a lot of RIAs that have built great books of business and are precariously close to retirement with no transition plan. So we know what that means, because they're either going to retire through attrition, which, we do hear that a lot. They say that I love what I do, and I die at my desk. Well, unfortunately, we deal with that once, sometimes twice a month, where we've literally had to drag somebody out of their office and we've got to find a successor. We're dealing with a grieving spouse. So there's going to be a lot of transitions, I think, in the next couple of years, specifically the next decade for sure. How does that impact values? Well, I've put up here the gross revenue multiples. So we're looking at recurring revenue across the top there in blue, non-recurring are the commissionable, one-time transactions down there at the bottom. So you can see the trend, going back to where we had enough data that it was, worth reporting, back to 2013. So you can see the trend line, it's been continuing up. Yeah, I think as we predict the next 10 years, I think this could be as early as the next 4 or 5 years. I think when you look at the smaller deals, where we're really talking about buying a book of business, revenue, clients, and the assets that come with those relationships, you still don't want to use a multiple of revenue or even a multiple of earnings to buy or sell a business. These are just benchmarks and barometers, but they're still useful benchmarks and barometers. So with the smaller deals where you're focused on just a book of business, top line multiples are a decent benchmark to compare against. And I think the RIAs are going to end up being close to probably a 3 times multiple. And I'll give you the Cliff Notes version of my rationale here, beyond just the obvious trend line in front of all of us. I say this because when you look at deals back here, let's say before 2015, 2016, there really wasn't any bank financing. And so if you want to try to buy these practices, you had to put down 20 or 30% of your own money, so when you had it, and you pay for the balance out of cash flow to the seller. Well, the seller didn't want to loan the money for very long, so they would do it over 2, 3, occasionally 4 or 5 years if there was a really high level of trust. but you're still trying to squeeze a deal where you're paying, let's say, 2.6 times the gross revenue. This is top line. You're paying 2.6 times the revenue, and you're trying to pay it back over 4 to 5 years. After expenses and taxes, throw in some debt service, there's no money left over. You couldn't have paid more than 2.6. But now, fast forward, here we are, 2019, we're heading in 2020. Now you can bank finance the entire deal and you can do it over 10 years. Well, that's a lot like looking at home values today versus home values next year if all of a sudden all the banks came out with a 60-year mortgage. Would you go buy twice the house? No, because you're savvy financial advisors, but I might. So that's basically what's happened in the financial services industry. You went from everything being squished into a 5-year payback to now having 10 years to do it. So I think just the free cash flow in these deals is going to cause values to go up. Whether you measure them on a gross revenue or earnings multiple basis, I think they've got nowhere to go but up. Again, I'm talking on the smaller RIA deal.
And David, I think it's worth reflecting on that as well. There is an interesting juxtaposition to this change, because I know some of the discussion years ago was, sellers that didn't want to take that long-term risk would say, well, go get bank financing, find some way to give me more dollars up front. And a lot of buyers didn't want to do it because they were afraid of the deal risk and the expectation. I mean, I remember some of these conversations, sort of at the beginning of this chart as bank financing showed up. And there were some discussion about whether valuations were going to go down because the risk to the buyer becomes escalated when you're buying, the goodwill of, I hope all these clients stick around, and I'm going to borrow a giant pile of debt, put it down for the risk of this business, and pray that the clients really do stick around and that they're as attached to the firm as the owner says. And so I do think it's interesting reflecting that there's both an increase to the buyer risk, and I think as David DeVoe will talk about later, deal structures have changed to some extent with adjustments to handle this. But there was kind of the good news was you could stretch payments over a longer time period. The bad news was maybe a little bit more upfront risk for the buyer in the debt. And to me, it was fascinating to see how these play out. On the whole, yes, there was some more risk, but we figure out ways to change deal terms to manage the risk. And overall, longer financing periods just meant we can afford to pay a little more. I think your analogy of what happens if we all suddenly got 60-year mortgage options instead of 30-year mortgage options, and your monthly payments fell in half, would you buy more house? And hopefully everyone won't buy double the house when their payments fall in half, but you might buy a little more.
Yeah,
you might buy a little more. And,
I'm glad you brought that up, because I couldn't agree more. Frankly, when I look back at, I've been doing this since 2004, and I remember when PPC loan was kind of the first real, bank to try to enter the space and provide the financing. And I thought for sure at the time, this is a terrible idea. Nobody's going to want to borrow the money because you're buying an asset that has the ability to vote with its feet. Why would somebody go
the whole
borrow
reason
a pile of
it
money?
was hard to get bank financing was because the banks could be like, where's your collateral?
Right.
We got no collateral. That's a risky loan. It's the banks didn't even want to lend for a long time because it was so risky. Yet here we are. Now there's a bunch of, quote, risky loans, and deal values went up because longer financing periods actually, on the whole, reduces the cash flow risk.
Well, I'll be provocative. Disagree.
All right.
Valuations, I don't think, are going up because of access to capital. We've seen a huge proliferation in capital. We've seen more capital enter this space and more innovation and more players into the space in the last 12 months than we have the last 12 years. And 15 years ago, I tried to get banks coming into this marketplace when I was at Schwab running their M&A platform. So good news, capital has come into the space. And a couple thoughts. I don't think capital is necessarily going to increase either valuation, or I don't think it's really going to drive an increase in the number of deals that are going to be done for most buyers. I think capital has not been a constraint for most buyers. So I'll tell you where I think it's going to affect it. I think the very large firms, the Hightowers, the Mercers, these larger organizations, they've had access to private equity, Focus has access, all these firms have access to debt. That hasn't been a problem, that hasn't changed. Private equity is even more interested, but they've always had access to capital. That hasn't been a constraint. And frankly, the one and done transactions, a firm that wants to go out and acquire one firm, I don't think was capital constrained either. it's really, I think, the one place it might affect it, because I don't think either ends of that barbell are going to be affected by the access to capital. The place where it is going to start to influence things is firms that were going out and making several transactions. Once you start to get into a debt stack, once you start to have, primary, secondary, tertiary positions on the debt, it can constrain your ability to do more deals. We're working with, we work with firms that have 100 million, a lot of firms that have $500 million, and a lot billion plus as well. But it's those multi-billion-dollar firms that are now 5 deals in that have constraints on capital because of all these loans they've taken. I think that's where it's going to influence it. And I will counter too on the valuations. We might be at a high. I'm not sure I'd say valuations are going to go higher. The data points here, I assume this is for firms under 100 million, and anyone who's heard me speak, I have a visceral reaction to multiples of revenue. But, just to be provocative, I'll throw it out there. I wouldn't necessarily bet the valuations are going to go up, and clearly should not go up because of access to capital. If you're not willing to put your own money in play, taking on debt, which would make the risk profile actually increase. If we have a market correction, and you have debt on the books, then it's going to be more challenging. So by all means, I'm very respectful of trying to make it an interesting conversation as well. But for, I guess, not just fun, but to be both provocative and honest, those are my 2 cents on it.
Yeah, no, it'll be interesting. I mean, frankly, it's an important point for us to talk about, the industry to think about, because these just weren't even conversations that, frankly, most RIAs even had or cared about, because there wasn't any bank financing. To your point, David, you've been doing this, frankly, longer than any of us. The bank financing, like Michael pointed out, wasn't the most enticing opportunity for a bank or a lender because there is no collateral. But I think what they've found so far, the Live Oaks, the PPCs of the world is, for the smaller RIA, it's almost better than collateral, recurring revenue.
Yeah.
Versus most of our businesses, Succession Resource Group, clock strikes midnight, it's January 1st, and we start over. And that's the way you build a business. Every year you start over, and you as RIAs just don't necessarily have that same problem. So the banks seem to really, like it. They see it as a low risk scenario. So it'll be interesting to see. I mean, to your point, David, do these values, regardless of whether you measure it on top line or bottom line, do the values across the industry continue up? Do they trend down? I think the interesting juxtaposition with this all is the volume of transactions, which I'm not going to steal your thunder because I know you got a slide coming up on that. But I think the volume of transactions that we're going to see in the next decade is definitely going to have an impact. I thought I'd share this real quick. Again, just looking at top line recurring fee-based multiples. It was really interesting because when we looked at data back in 2010, for example, deals happened at, whether it's, 4 to 6 times earnings, or in this case, let's say 2 to 3 times, top line revenue. Yeah, it's always been in like the 2 to 3 times range if you're looking at the small deals where you're just buying revenue. But it was pretty concentrated at like 2.5, 2.6. Good practices were a little higher, bad practices were a little lower. Contingencies on the deal, how you financed it would impact it. But now here we are, this is the data from 2019. And again, as David DeVoe pointed out, the smaller RIAs, you can see the range of multiples paid. I mean, these things just keep expanding as buyers become more aware. They get more creative with their deal structuring. They're sort of taking a note, I think, from some of these large aggregators where you've got now, I'm going to say small RIAs, but 200 or 300 million in assets, and they're buying a book of business, half in cash, half for equity in their firm. You just didn't see that stuff 10 years ago. So it's been really interesting to see how creative, the advisor space has gotten as the market, I think, has evolved, for better or worse.
David,
overall, yeah, Dave, Michael.
Sorry, just
please.
A quick question on this. I guess like that I would pose to the two of you. The going rule of thumb out there for probably the better part of 10 years has been a 2x revenue multiple,
yeah,
with all the asterisks about the caveats of multiples of revenue. But that's sort of been a benchmark number out there. You've got a chart here that essentially says actually the median's more like 2.6, 2.7, which in real dollars, that's not a trivial difference. As someone's listening to this call going like, holy cow, my business, David said my business is worth 30% more than I thought it was based on that rule of thumb number before. Like, how have we gotten such a gap between what you're showing here in activity where only 7% of the deals are happening at 2 and the kinds of rules of thumb that we've been talking about for 10 years around 2x?
Yeah, I mean, I'll give you my perspective, and then, David, I'd certainly love yours as well on this, because I know you got one. When you look at the last, 10 years, yeah, everyone talks at 2 times multiple. Maybe if you were a little more informed, you might talk 2.5. It's definitely in the last 5 years, which, and again, I'm not going to necessarily draw the correlation on cause and effect, but I can tell you the one thing that really changed, having talked to a lot of buyers, that impacted their perspective is access to capital that they did not have before as the small independent RIA. Now, all of a sudden, I mean, you can see the data here. I'd love to tell you this is my amazing insights and perspective. This is literally just us pulling the data from the database using Tableau and looking at actual transaction data we have. And what's really cool from my perspective that I think is worth sharing here is this isn't just our data. If it was our data, if we tell everybody it's worth 2.7, and then they do the deal at 2.7, it becomes somewhat of a self-fulfilling prophecy. Not a bad thing necessarily, but not necessarily objective. So this data includes ours, but it also has data from our broker-dealer partners. We've got data in here from LPL, from Lincoln, from Cetera. We've got deals in here from AssetMark. We've got deals in here from PPC Loan and Live Oak Bank. I mean, literally hundreds of deals, the vast majority of which are not transactions that we necessarily help facilitate. So I think it's a good cross-section of the smaller independent RIA market. But from your perspective, David, what are you seeing out there?
Yeah, and I don't want to be the party pooper. So a few things, I feel compelled to say. Using a multiple of revenue is just not a good way to value a firm. It's a dangerous, it's an irresponsible way to value a firm. You're talking about using math that, an 8-year-old kid can do in their head to value someone's life's work. This is not a good way. And, I'm a business trained nerd, business school educated nerd, but this, I think it holds just, this is the equivalent, I think, to going to people and saying, oh yeah, whatever your age is, take the reciprocal of that and put it into fixed income or something. So, yeah, I think overall, a few thoughts. Valuations have increased. They've increased significantly from 2008 or 2009. We went from an all-time high back in 2007 to pretty much an all-time low in 2008. And multiple of revenue multiple of cash flow is going to be a more responsible metric to use. Still a dangerous metric. You're using math. A 14-year-old kid can do in their head now to value someone's life's work and multi-million-dollar firms. But if you look at those multiples, it's hard to talk through a discounted cash flow while we're live on a call.
Right.
If we use that metric of, say, multiples of cash flow, 2008, we had this record level. By the end of 2008, it was at an 8er. And it has literally taken 10 plus years, to get back to that record high. It took 5 years to get back to a degree of normalcy that we've seen in the industry. So I think valuations have come up. Valuations have now eclipsed what we saw in 2008. I didn't think we'd ever see what we saw in 2008 because it was irresponsible buyers in the marketplace. It was unsophisticated buyers that shouldn't have been writing checks, whether they had capital or not. Capital probably exacerbated the problem. But we had banks that had certain business models. We had folks that had raised money that should not have been in the game, and they were driving up these valuations. So I was actually, I started getting surprised as we started seeing these valuations creep back up and bumping up against it. I will tell you, we have now eclipsed valuations than what we saw, 12 plus years ago. But the interesting twist here is it is reasonable. We now have sophisticated buyers in the marketplace. And some of those firms, and I'll come back to this, but some of those firms have created, honestly, a great mousetrap. If you sell to certain of the, certain consolidators, these mega firms where their business is focused on going out and making acquisitions, many of them have taken a scientific approach. And when you sell to them, they are going to make your profits expand, and they are going to make you grow faster. They've done a great job of that. If you can make a company's profits expand and grow faster, you can pay more. If you can't, you shouldn't. Matter of fact, in the marketplace today, we said this in our latest deal book, our valuations at the all-time high, yes, but they are very distributed. If you sell to the firm next door, you should not expect an all-time high valuation. Anyone who's on the call, who's a buyer, I caution you about paying, one, this approach, but also paying at the high rate just because the other kids are. This is a recipe for disaster. You really want to be thoughtful, especially if you're taking on loans. Those have to be paid back. There's some skin in the game there. So you want to be really smart. And when you think about acquiring a firm, make sure that, hey, is this going to be accretive? Project in the future. Is this going to create value? And then you're in a position to start thinking intelligently about how to price it effectively.
Yeah, no, that was perfect. And frankly, I mean, to your point, David, these numbers here on the last slide that I had up, these are simple rules of thumb. This is the equivalent of knowing the average price per square foot of residential real estate in the US. Right. It's not bad to know, but it is not a valuation method, to his point.
Very high, by the way.
Yeah.
I just, as part of the community, I want to make sure, I fight every day folks that have unrealistic expectations of what their firms are worth. 2.3 times I think is high for any firm over 150 million. It starts to get high, and there's ranges, et cetera. So when I see things even above that, I just get a little worried. You just really want to be smart, both as a buyer as well as a seller, to think about what's appropriate in the marketplace. Now, if you're under 100 million, these are more reasonable because someone's retiring, the economics are exploding. It's a different set of characteristics than a firm that is a going concern over 100 million plus.
I couldn't agree more. So, I think at that smaller size, right now, our position is just based on the data that, these practices remain undervalued. But to David's point, we have a lot of these conversations. I literally had one this morning, but we have them every day. And I know you hear it too, David, that sellers, owners of their businesses, I think almost always have an unreasonable expectation of what that business is worth, which, to be fair, if anybody's going to have an unreasonable expectation of its value, it should be you as the owner. I'm sure we'll all have that of our own businesses someday, despite having preached, this stuff for a very, very long time. For me, it more comes back to, and this is true probably for you too, David, it's got a cash flow, short-term, long-term, combined buyer-seller businesses. And this is where I think the banks have been especially helpful in helping say the same thing that we've been saying, that a lot of these practices are either overvalued, the deals that they're being put together are far from recession-proof. And that's been nice with the banks because kind of like buying a house, if it's all just land sale contracts, seller carried notes, who knows what the value is and who's to come in and say that it's not worth the $2 million I agreed to pay. But as soon as you bring a bank in, well, guess what a bank requires? An appraisal. So even if you end up striking a deal to, as you point out, David, maybe overpay in some of these cases, the bank ain't going to finance it. So now you end up having to bring either more cash to the table, which again, just use the real estate analogy, none of us like doing. So you end up then kind of having to try to get everyone back to reality. So that's been the one nice thing that, to your point earlier, Michael, you bring bank financing in, put a bunch of cash down, change the risk profile on that deal. Well, you better make sure that the deal cash flows, that it appraises. But right now we keep seeing the trend, up for the good practices. And again, we'll get into maybe how we define those things, because big practice, small practice, there still are good practices that maybe deserve a premium, but there's a lot of them out there that they're doing a needs-based valuation. And frankly, I tell you, that's more dangerous than even just applying a multiple of revenue, because needs-based values are interesting. They're good for planning purposes, but what you need to be able to retire isn't necessarily what that business is worth. So I'm curious to see where we're headed here. But again, for me, a large part of this, the wild card, is deal volume. So I'm going to hand it over to you, David, because you're actually really good about publishing this stuff. I think, certainly every year, but every quarter. So I know you got your finger on the pulse of things. What are you seeing?
Yeah, absolutely. So, and contextually too, I think you and I focus on different parts of the market. So the data you're seeing here is, SEC registered RIAs, which is really where DeVoe and Company focuses. So I don't want to rain on the parade too, because I think a lot of the data you shared earlier has to do with the Ceteras of the world, et cetera. We don't play in that space. We just live and breathe the RIA world. So the data points ahead of you is SEC registered firms, RIAs with 100 million or more. And it's not that firms under 100 million are bad. many of our clients are under 100 million. It's great. There's 5,000 RIAs in the industry. These are great business models. They're serving the investment public. You know, these are top earners. It's not that under 100 million is bad. It's just that data points get scant, or it's harder for us to have consistency of data points, I should say. So in either case, what you see here is, you know, RIA M&A activity. This is something I've been tracking 17 years now. And you can see this upward trajectory. Matter of fact, if you look at 6 of these years from 2015, actually 2014 to date, these are 6 successive record years of M&A activity. There was actually, you know, a couple years prior to 2013 that were above 36 transactions. So we see this upward momentum, and it's really driven by a couple of different factors. You know, David Grau talked about it earlier, the demographics of this industry, right? The owners of these firms are aging. They're slowly and methodically moving toward retirement. And I think all 3 of us wish there were more succession plans in place. It's a little scary. I think we're hitting crisis mode, that we have this lack of succession planning when you overlay that with the fact that a lot of advisors are moving toward retirement age. So I think succession, you know, I've been doing this 17 years. The first 15 years I did this, succession planning was the #1 driver for mergers and acquisitions. It was the #1 reason people were selling. The last 2 years, the #1 reason has been scale. Now, succession planning is right behind it. Succession planning will be the #1 reason again in the future, a couple years out. But right now, scale is what's driving the majority of transactions. What do I mean by scale? You know, I have a $200 million firm. I join forces with a firm 2 or 3 or 5 or 20 times bigger than mine. You know, my life is going to get better and easier. I'm a $600 million firm, a $2 billion firm. There's this upward momentum for firms to join larger brethren because of the benefits of scale. So what does that mean? One is it can give a greater breadth of services and capabilities, right? I now have access to estate planning or alternative investments or specialized financial planning experts or CPA. You know, the service and the capabilities you can add to your clients can be much more powerful as you're part of a $80 billion firm or whatever it might be. So that's part of the equation. As importantly, too, you join a larger organization and some of the garbage comes off your plate, right? You're spending right now 20% of your time on administrative tasks. You're spending another 25% doing things you don't enjoy. Well, if I join brand X or Y, Mercer, Hightower, Wealth Enhancement Group, whatever it is, a lot of these firms, they've manufactured an organization that can take a lot of these headaches off your plate. So that also is driving a lot of the M&A activity. People are looking to really not only to optimize their business and their value proposition, sort of perhaps be in a better position to weather a storm if the market does ever go down. I don't know, maybe it will at some point. But it's also the ability to really have a better life, not necessarily lifestyle. A lot of these people are driven to work hard, et cetera, but it's to take the headaches off your plate and focus your time on energy on something that's much more interesting.
So I'm curious real quick, David, on the trend on deal volume here. Is this kind of what you expected? I mean, you've been doing this for a long time, back to your days even at Schwab, to where you sit now. Yeah.
So we're now at a record high. I mean, look at last year. We had a 30% increase over the course of last year. This is a big uptick. We need year after year of 30% increases for, I'd say, the next 5+ years. You know, what do I mean by that? Yeah, we're at a record high. We're still at half the volume I think we should be seeing. We should be seeing twice as many transactions in this industry for an industry that has, say, you know, depending on the data point, 10 or 13,000 firms. We're looking at, say, 5,000 that are over 100 million. When you start to do the math, especially with the demographics, you realize we should be seeing way more transactions. So each year in 2018, 17, 16, 15, we only saw, you know, 50 or 100 deals. That means another 100, 150 firms didn't come on the market that probably should have. So we have what I believe the growing supply of sellers that is going to come into the marketplace at some point. And I'd love to see 30% year after year, and the body of the community of buyers can expand. So I will tell you right now, if in 2020 we had twice as many deals, 260 deals in 2020, we would have a problem. We don't have enough qualified buyers in the marketplace to absorb twice as many firms. You know, the data point's 50 buyers per seller. You know, I'll be crass for fun. I'm the provocative guy on the call. Out of those 50 quote unquote buyers, I think probably 7 are qualified to be a buyer. It's a lot of energy to go be a buyer. not just capital, what we've talked about, infrastructure, all these, you really got to have a machine to be able to take on that massive risk of absorbing a company. So if we had twice as many sellers next year, I think we'd have a challenge and firms wouldn't be able to sell. So when I look forward in the future, and I'm happy to elaborate, momentarily on, well, should I do that? Should I jump forward to another?
So David, maybe as you jump forward, I do have two quick, I guess, follow-up questions for you. So on the one hand, the deal trend volume certainly is there, and you can see kind of the 3x growth in 5 years. But we continue to get the drumbeat from Cerulli. A third of the advisor headcount is going to retire in the next 10 years. 5,000 firms over 5,000 plus firms that are over $100 million that you said are SEC registered. So if I'm going to wind through a third of those over the next 10 years, like I need 150 to 200 deals a year to absorb that volume if they're going to flow through at that rate, which to me says like some uptick in volume, and maybe there's still a little bit of a dearth of why aren't there more sales and why haven't there been in recent years. But if we're going to get even a portion of that uptick and you don't think there are enough buyers out there, does that eventually put downward pressure on valuations? Because notwithstanding the 54 buyers to a seller right now in the seller's market, does that start turning into a buyer's market if the wave actually shows up finally?
Yeah, a couple data points. I think you're spot on in your thinking. And by the way, on one hand, it's the retirement. Right now, we know half the deals are for scale, right? So it's not only the succession and the scale that's going to drive it up. So yeah, I think you're absolutely right. One is, again, provocative, Dave. On one hand, it's a seller's market. And, I've been hearing this for 17 years. I'd counterpoint, I'd say, right now, it's a buyer's market too. Why would I say that? What do I mean by that? Well, one, look at the data. It's never been a better time to be a buyer. We've seen, as you just said, like 5 times as many deals as we saw, less than 10 years ago. We're also seeing data that says that there's openness to having a conversation. We do a survey. We have a couple surveys a year now. And, more than 50% of advisors are now interested and willing to have a conversation about a sale. Years ago, they wouldn't do this. There was reticence to do so. So I think in many regards, there's never been a time in the history of this industry. I've been doing it for 17 years. Granted, the industry was just a shadow of what it is today, 17 years ago. So I can say emphatically, there's never been a better time to be a buyer because so many people are selling and willing to entertain the concept of selling. Now, if we did have twice as many firms coming on the market, I think absolutely the valuations would go down. I think we'd be left with many sellers that didn't have a chair to sit down on when the music stopped. We would have a situation where not everyone could sell their organization. So I think that downward pressure would and may actually occur at some point.
Yeah, that's been my perspective, and frankly, worry for a long time is we see this data, to your point, Michael, from Cerulli. I mean, honestly, just go to an FBA chapter meeting and stand in the back of the room. Half the room has white hair or no hair. I mean, you go to the NAFA meetings, on the insurance side, it's even worse. Nobody has any hair. So, from an industry perspective, buyer to seller ratio might be 54 to 1. David, I think you were generous in saying, 7 of those might be qualified. It's probably closer to 4 or 5. And it depends on the practice. So as you look at the industry and say, okay, well, effectively nobody has a succession plan, or very few people do. And their average age of advisors, I think the youngest that I've seen cited, which is pretty consistent with the data that we have, is like the mid 50s, 55, 54. I mean, it's a scary proposition when you look at, I think the average compounded annual growth by advisor headcount over the last 5 or 10 years, I can't remember the number, but it was down 0.7%. I mean, just, things are going in the wrong direction long term. So I had this question teed up for you, later, Michael, but I think now's a great time to ask it. What are your thoughts? I mean, from an industry perspective, we've been talking about succession planning as an industry for a long time. I mean, I can go Google this stuff on, Nerd's Eye View and find you've been talking about it way before it was sexy. So why haven't we made more progress? I mean, it's a group full of professional planners. What are your thoughts?
Well, so frankly, I think the sort of the hand waving discussion from Cerulli of the wave of advisors retiring is a little bit overblown. So yeah, I'll take Mr. DeVoe's provocative hat for for a moment here. I mean, a lot of that data essentially comes down to, median age of advisor is 50 something, depending on whose data you use. So, like a third of them plus are going to be eligible for Social Security in the next 10 years and hit normal retirement age. So we're going to have these wave of sellers. I cannot remember the last time I met a financial advisor who decided it was time to retire and sell his practice because he was eligible for Social Security. That is not the driver. For some advisors, I'm tired, I'm ready to be done, the business isn't fun anymore. That can hit you anywhere between 50 and 80, depending on how long you've been doing it and how bored you got in your practice. Otherwise, for the rest, these are going to be health-related events, frankly, that will usually drive it. Either, unfortunately, something happens and we go out horizontally, so that's a very sudden sale, or we have a health scare, God willing, everything goes away. Okay, we get through it, but we say, okay, I've realized it's a change in my life. I think I need to exit this. And, if we start going down to where really do people start having a material volume of health events? It's in your 70s. It's not when you hit Social Security age. And so I think, for a lot of advisors, the exits are going to come way later than anyone expects. If you've been doing this for 30 plus years, you usually make a pretty darn good income, especially if you convert it to a recurring revenue model. You don't need to grow much. Your clients pay you a pretty good amount of money. You have gravitated up to more affluent clients over time. Most client meetings involve good lunch and golf. And you might make a couple $100,000 a year, work 20 or 30 hours a week. Why would you leave that sort of health impacting you? Even for firms I've seen that try to start preparing themselves for sale, going to bring in some more staff. I'm going to systematize a little more because that's what I've got to do to sell. They start doing that. Then they systematize their practice. And they say, well, now it's actually really easy to own and manage. So I was going to sell, but getting ready to sell, put the staff infrastructure and systems in place that now I don't even want to sell it. No, I can. And even just the mathematics of it. I mean, when you talk about these numbers you call it the 2.7 times revenue, for a lot of advisory firms, if you are a really high income successful solo and you put a little bit of focus on that, it's not uncommon to see firms taking 60 to 80% of their gross revenue home as take home pay, particularly when you're in the solo and small end. And so when you're down at that level, I can make all the money of the sale in 3 years and I'll still own it 3 years from now. So I can sell it then, except I get 3 years out from then and I'm still making really good money and not working that many hours. So why would I sell it then? And I can keep going. And the more that I start attritioning my practice, the more time effective, sadly, it gets because the client load starts relieving itself. And I just do less work and still make really good money. So I'm actually very skeptical that the wave of exits is coming over the next 10 years. It will come 20 years out. Age and demographics are still destiny. But I think there's actually room for this to spread out much, much further, particularly as firms get to a size where even just some of them can start facilitating internal succession plans. And that I'm still actually skeptical that the selling wave is coming. This is a drum I beat for the better part of 5 or 6 years now. And we still haven't seen it, even as much as deal volume has picked up here, relative to the aggregate RIA space, we're not on pace to turn over a third of our firms in the next 10 years.
Which I think is a wonderful segue for what you were going to talk about, David, on what you're seeing on, the internal succession versus those that need to sell externally. Yeah.
So let's see. So do you mind clicking back to you, and then I'll sort of let this build. Perfect. Yeah. So, a couple things to consider, and I love the provocative. This is fun. It's always fun when it's provocative. And I'm going to be in violent or agreement with a lot of things that Michael just said. So, with what I have here is a snapshot, and this is starting to think through, from a seller perspective, what the option set is. And I think a great thing about this industry is most advisors want to sell internally, which is a beautiful thing. They're not out to get the biggest dollar or, get rid of this business and sell it to this or that. They generally want to sell it internally I think generally, which is a great thing. The challenge is a lot of times they can't. Now, let's think about it. If you're, we have the sort of the a continuum.
Whoop, David, you got muted by accident. Hit your space bar again.
Have I been muted all this time?
No, you just bumped in.
Just for a second.
Just for a moment.
All right, thank you. Thanks for catching me. So yeah, let's say you start your organization, you're running it, and you're a sole practitioner. And let's put a stake in the ground, say 100 million. I think around 100 million, could be 80, it could be 120 is where you cross that chasm that Michael just alluded to, where, you know what, maybe this is no longer a sole practitioner. Maybe you're going to bring in, you're going to take 150K out of your pocket to hire someone who could potentially run your business. So for this, 5,000 firms, that's under 100 million if they are a sole practitioner. By definition, if you're a sole practitioner, you can't sell internally, right? You have an admin or some operational person. Then you hire someone who could be a good fit, and you move into the second stage where, you have 100, a couple 100 million, you got 1, 2, 3 people that are qualified to run this company. And frankly, they make enough money that they can afford to buy it. And that's a fantastic thing. But eventually you hit a point where the company gets bigger and it's growing faster and faster. And you're not dialing it in and working 20 hours a week. You have a team and a machine, and they're growing this bigger and bigger and bigger. And there's a certain point, it could be 500 million, depending on the timeline. It could be $1 billion. Tim Coaches, he's part of the team here at DeVoe and Company. He says, wait a sec, Aspiriant has $10 billion and they are doing it internally. He maybe changed the slide. So it depends on the characteristics of the firm and the value, how quickly it's growing, the buying power of next gen and the deal structure. But there's a certain point where the mail truck is just going too fast, and and the dog's not going to be able to catch it. So when you're thinking, if you're a buyer looking at this equation, I can tell you, it's a happy hunting ground under 100 million. There's just a lot of firms that have to sell. And I think we need more organization. Those 54 buyers that David alluded to earlier, those folks becoming experts in acquisitions are going to be good because we have thousands and thousands of people that have to sell. Once you get really big too, you need a third party. That's where the capital could come in, private equity or these mega firms. And in the middle, you have that luxury of selling it, internally or deciding to sell externally. So it really creates, sort of this thing where the smaller firms have to sell externally, the big firms have to sell externally, and then those in the middle can potentially sell internally or not.
So David, I have to admit, I would push back on this a little bit, maybe kind of tanking Tim Coaches' side on this, that getting back to David Grau's comment earlier, that to me, the blocking point that limited a lot of buying, I think particularly and especially for our internal succession plans, essentially came down to the seller financing dynamics. Sellers often didn't want to go more than 5 years. Maybe you got to 7. So just if I, start doing my napkin math, like if you're going to stretch a 2+ multiple revenue over 7 years, I'm going to have to pay 30+% of the payment a year. That firm might only have 25% profit margins, and I got to pay taxes on that. And so I just flat out couldn't cash flow the deal. Like I had to come with ongoing cash flow to the table, and I couldn't make up the gap with my salary if I'm buying a multi-billion-dollar firm. When we get in this world of bank financing, where suddenly I can potentially stretch over 10 years, and amortization the payments gets a little more manageable relative to at least highly profitable firms, and of course I think you'll talk about later, like businesses really don't get valued on multiples of revenue, they get valued on multiples of cash flow. And one of the reasons that works is if you finance over a long enough time period, the deal largely cash flows. You have risk at the table, but you can get close. And so I wonder how much of this is like in large firms, they just can't afford it, and how much is in large firms, there's often a reason you took that job instead of being the one that starts the firm on the other end. Like there's a risk appetite issue that, if a couple of partners are going to get around the table for $1 billion firm that might sell for $20 million, you got to look each other in the face and say, you going to take on $5 million of debt? Am I going to take on $5 million of debt so we can carve up this deal? And I feel like I actually see that as the blocking point. They just don't have the risk appetite because there's a reason they picked that path in the first place, as opposed to I just literally can't come up with any way to finance this deal, which seems to be getting easier as more of the bank financing comes to the table.
Yeah, so a lot in there, and I'll try to unpack it. I'd say, ultimately, you need to you don't want to, I don't know, you don't want to buy a house or a business based on, gee, I'll pay more and more and more as long as I can pay it out over a longer period. That becomes irresponsible, right? So,
true. Getting back to David's comment, but if the only option to buy a house was a 5-year mortgage, right, most of us just wouldn't own one. Like, we couldn't make the math work by any means. At some point, this period stretches long enough that at least now I can have an affordability conversation.
Yes,
I couldn't have before. Now I've just got a risk appetite conversation.
Yeah. So we're wholly aligned on one point, which is, and I'm the only one saying it so far. I don't think the capital infusion that we're seeing in this industry is going to significantly impact M&A.
Okay.
I think it's going to significantly impact succession, what you're saying. And part of that is you can stretch it out over longer periods. I think still you need to be responsible with valuation and cash flow and things like that. And I'll come back to that. Yeah. Also, there's a lot of advisors got into this business. They're like, hey, I wanted to help people with financial planning. I didn't get into this business to be a bank. I don't want to loan money. I don't want to, be a bank. And so I think the capital infusion, I think, is going to really help with the succession side. However, that mail, truck, and dog, I think still fits. If you have a firm, even if, your analogy, $10 or $20 million value of the firm, you're going to take 5, I'm going to take 5. Well, at some point, if I'm a seller, I know I can take it to the market and get, when we represent sellers, we negotiate about 38% more than what that firm might be worth on a discounted cash flow basis. Another way to say it is the internal folks will expect it to be at a certain price when certain buyers will pay a premium for it. So a lot of times the buyers are like, okay, gee, sellers, I know I can get this in the marketplace, or buyer, next gen, I know I can get this in the marketplace, are you willing to pay that? And often they're not. The other thing is, if you're making, $250K, you probably can't get a loan. It's probably not the right fit to be able to take on $5 million. So what happens then? You either have a, minority stake that's coming in that's part of the equation, which can be great because you and I, back to your analogy, we're both shareholders. We both got $1 million or $2 million riding on this thing, crossing our fingers, let's go do this. But someone took the other, $6 million off the table, or $4 million or $2 million. So we're seeing this, passive capital coming in, minority investments, et cetera. And part of that's just because, when someone's making hundreds of thousands of dollars and they're trying to buy a firm that's worth millions or sometimes tens of millions, it's just the math isn't going to work out, if that makes sense.
Okay.
Yeah, no, I love that. And frankly, the nice thing is, I think we're all sort of saying the same thing. And I know at the smaller size deals, again, to carry the analogy through that you just touched on, Michael, if the norm for buying homes was a 5-year mortgage, we'd all be living in, very fancy tough sheds. But or you'd be a renter, to your point. So I know for the larger firms, Live Oak, PPC, Skyview, all these banks, Pinnacle start providing capital. They weren't using it. They didn't need it. They don't need it now. But I can tell you, for the 50 million firm, the 150 million AUM firm, capital was somewhat of a constraint. And now, I put up the slide here, deals, the first half of the decade, maybe a third down, 2/3 seller financed. And again, you go back to, Michael, your commentary, of what goes through the head of a soon to be, or what should be soon to be, a retiring advisor. They're coming back saying, retire from what? I don't work that hard at this point anyway. And I like my clients. They seem to like me, especially the way the markets are right now. I'm not working that hard. So the idea, in the first half of the decade of carrying 2/3 of the debt and getting paid out of cash flow wasn't super compelling. So I think that's, a big part of why we didn't see more people even considering, transition, even when they did have health issues. And now you fast forward the second half of the decade, whether it's impacted values or not, it has impacted deal structures because of the data that we've seen out there. And again, it's a pretty big cross-section of the industry on the small side, mind you. Now, when you can go borrow the money and pay it back over 10 years, well, pretty much everyone is when you can get access to it. And most people have access. So you can see our trend here back in the early 2000s. nobody was using bank financing because there were no banks. And, you have banks starting to enter the market, and now we've got, I'm not going to say a lot of banks, but I can still count them on probably two hands, but that's a lot more than we had at the beginning of the decade. So we're definitely seeing a trend, up in terms of bank financing being available, banks that understand an RIA from an IRA, which is an important distinction. And now here we are all of a sudden, of the data that we saw for those, we'll call it 500 million, certainly a billion and under, but the smaller RIAs, you got 60% of these deals happening where they're paying for the entire deal in cash at closing. I mean, you never saw that before. So for me, the bank financing, whether it impacted values directly or indirectly, it did create more buyers, and more buyers has generally led to more bids. More bids leads to higher values. So that's been my perspective. I'm curious, from your perspective in the seat you sit in, Michael, you get a pretty good macro view and micro view. What are your thoughts in the next decade? Any major disruptors that you expect?
So I think the looming elephant in the room is the next bear market. I don't quite know when it's going to come, and I'm not going to forecast with detail, but I'm willing to go out on a limb and say it'll happen in the decade of the 2020s. Okay. And I think the next bear market becomes an interesting catalyst. At least the buzz I hear anecdotally was a portion of the uptick in deal volume last year was, I don't know when the bear market's coming, but we're 10 plus years in. Someone else can deal with it. I'm getting out why valuations are pretty darn good. And you even see high profile folks like Peter Mallouk taking a chunk of private equity dollars to not necessarily take some chips off the table, but to build up cash so that he's got a reserve for the next bear market because he thinks valuations are better now than what he can get going through the next cycle. I think, frankly, the bear market will have a lot of interesting separate effects as well. I'm not convinced that the wave of sellers is coming based on retirement ages because I think it's going to be health-driven, and health-driven goes further out. But the fundamental reason why you keep staying in your business is it's fun. You're having fun. You enjoy your clients. You make good money. It's psychically gratifying just to do the good work we do with clients. The fun goes away in a bear market. I've at least been through 2 full cycles in my career. The fun goes away for a good 2 or 3 years. And my gut is that's actually going to drive a lot of sales activity. It's going to be an awkward challenge because, as David noted, limitations on buying capacity to buy all at once. Cash is less available in the middle of a down market in general. Lending tends to tighten when things are falling in recessions. Advisory firm revenue will be declining, which is going to make lenders more wary. So I do have some worry about what happens in the next bear market. I'm worried, ironically, it's going to lead to a rush of sellers, even though it's generally a terrible time to sell, particularly in the smaller end of the market, right? Larger firms, you build the systems and structure and management and compensation systems and the rest to hopefully weather the storm. In the small and solo advisor market, you do it as long as it's fun, and you don't do it when it's not fun. So I actually worry, particularly at the lower end of firm sizes, that I think the next bear market will actually create an ill-timed rush for the exits. I don't know if that necessarily means you sell now, because the math I talked about of hanging around and keeping the cash flows may actually still be good math for you. But I think there's going to be a challenge in the small firm environment when the next bear market cycle comes. I'm less worried about it in the large firm environment. Prices will come down a little because we do multiples of free cash flow that don't look as good when you have less free cash flow because your top line revenue takes a hit and a lot of that drops to the bottom line. But I at least not necessarily as worried about the multiples. You might multiply times a lower profit. But I worry about it at the lower end. And even for large firms, just the values, not the valuation multiples, but the values obviously come down in a bear market cycle. And I think that's the biggest X factor out there. And then we're already seeing people starting to figure out, if I'm not selling now, I got to be ready for potentially 5 to 7 years because I may have to ride a downturn in a recovery. And if I don't have a 5 to 7 year time horizon, I'm picking up the phone and looking at sales in the large firm environment if I don't want to sweat that out.
Yeah, I couldn't agree more. And frankly, we're seeing, I threw up the slide here with our clawbacks that we're seeing on deals. Clawbacks, adjustments, true ups, they go by a handful of different names, but where the deal adjusts after closing, and it had sort of trended down for a while, which I thought was interesting. And then sure enough, market's really strong, but I think buyers are, optimistic, but wary. And so we're seeing more and more of these deals that, they are paying all cash. And then they're sitting half that money in escrow for 12 months to make sure, we at least get out of the gate strong and the seller is able to deliver what it is we bought. Because, at the end of the day, you can't make these deals recession proof, but as a buyer, you've got to be conscious of it. I mean, to Michael's point, whether it's a year from now, 10 years from now, it's going to happen.
Well,
you got to be
and
ready.
Cogs, I mean, the uptick in clawbacks perfectly aligns to when the Fed started raising rates and everybody in the aggregate started saying, I wonder if that means we're closer to the end of a slowing economy.
Yeah. So the other one I thought I'd throw in here, just an interesting anecdote, because we went from having no banks, financing these small RIA deals to, a handful of them now, maybe two handfuls. Pretty evenly split between those that are, the SBA lenders, the Live Oaks of the world, half the deals, a little over half. And then you got the conventional deals. The nice thing is most of the conventional deals, as you compare to the SBA stuff, the SBA loans are, straight 10-year amortization, pretty simple to understand as a loan product. The conventional loans, you see some more variation. There's a lot of the conventional deals happening where you get a fixed rate, and it's a pretty competitive rate, again, for a uncollateralized loan, effectively. But the conventional loans, for the most part, you're actually looking at like a 7 and 10 loan structure where it's a 10-year amortization, but a 7-year payback. So you got to be conscious of, if you're going to use this bank financing, evaluate all of your options, because it isn't like a mortgage. We've used the real estate analogy a lot here because it is applicable in many ways. But the financing is not one of them, because when you go borrow money to buy a house, it's more about shopping rate. Everyone else's loan product is effectively the same, 15 or 30 year. Here, you could line up 12 banks that lend money to RIAs, and you'll get 12 different loan profiles of what their covenants look like. So if you're going to get into the acquisition space, you haven't done it before, spend the time to figure out the financing before you're in the thick of things, because we see that a lot where, buyers end up talking to one bank because they got to get this deal closed, and they just don't have time to really peel the onion back on the subject. Few other closing comments here, then I want to get to our predictions so we have time to touch on a few of the questions. I think as you look at the deal structures into the next decade, we are seeing, as Michael had pointed out, a lot of folks who are saying, well, I don't want to say I'm getting out while the getting's good, but, well, multiples are at all-time highs. Everyone's predicting this glut of sellers, whether it's the next couple of years, the next 20, it's coming. So they're selling the business, they're getting their cash, and then they end up being employed, in many cases, like 3 to 5 years. It's on a reduced scale, mind you, because the deal still has to cash flow. But we're seeing a lot of people sell the business, get paid, and then keep working. The cool thing is when we look at these deals, because we pull our clients, 12, 18, 24 months after the deal closes, when you sell your business and you walk away 12 months later, you retain most of the book of business, which frankly, I still find astounding. To sell a group of relationships you built over 20 or 30 years to somebody who you met, let's call it a year ago, and to have 90-something% of those stick is pretty impressive. I mean, but when you look at the deals where the seller stays around for 3 to 5 years, the business actually tends to grow. I think it's a lot more akin to the stuff that, David was talking about, where you bring in these really large aggregators that, they just put your business on steroids. They build the systems, the processes. That even happens on a smaller scale when you plug in, for these smaller RIA deals, you plug in a PhD, a buyer who's poor, hungry, and driven. You connect those two together and some pretty amazing things can tend to happen. And you certainly don't lose any clients. So I think the trend towards deal structures is just going to be leveraging the bank financing pending any kind of major rate hike. I think people are pretty rate sensitive at this point. And while sellers wouldn't love to finance the deals again, if you can be charging 7 or 8% interest, depending on what your money can do in the markets otherwise, it could make sense. So I'm going to skip past a few of these because I want to get right to our questions and our predictions. So I'm going to toss out a few, and you guys can be the contrarians, agree, disagree, or add your own to it. But I think as we look at the next decade from the seat we sit in, I expect for now, barring any market corrections, any major changes to the number of and volume of advisors exiting, things kind of stay on the current track that we're seeing now. I think these multiples, I think the value of practices, regardless of how you measure them, I think there's still some room for them to go up, at least for the smaller RIAs. But I do agree with both David and Michael that, frankly, you think about the next decade and, knock on wood, there's no market correction. But I worked through 08, 09, and I would tell you, coming out of 08, 09 was the worst time to sell a business you spent 20 years building. But there were a whole bunch of those folks that have been coasting for a couple of years. The job is not fun anymore. It's really awkward, trying to sit under your desk and not answer the phone when it's ringing. And this is not a great way to end the career. And so they would end up selling the business. And sure, it might be still at a decent multiple, but a multiple of earnings or revenue that's on a depressed number is still a lower value. So, but I think we're going to see at some point here in the next decade a correction. I think that's going to drive sort of that backlog of sellers that should have been retiring that just don't because the job's been pretty easy. It's a good job. They like their clients. And I think when that happens, that could cause, multiples of all shapes and sizes to start to pull back. I think with the market correction, interest rates are going to change with the banks, which is going to make the capital less exciting to go borrow. So I'm curious to see what the two of you think, but from our perspective, we're bullish on the next 10 years, unless I need to change my opinion and be more bearish.
So I'll maybe chime in. I'll give David the last word. As I look at these at the end of the day, and I'm probably setting up David nicely for this. Deals at the end of the day are done on cash flow. Not revenue. Yep. Revenue happens to work as a reasonable proxy because a mid-sized firm that's going to sell at 7 times free cash flow, if it was running a 30% profit margin through the 2000s, as many of those firms did, well, guess what? 7 times 30% margins on free cash flow values you at 2.1 times revenue, which I think is how we were ending up in that neighborhood. You ran 25 to 35% margins. You got somewhere between 6 to 8 times free cash flow. You ended out right around 2 times revenue, give or take a little. And the reason why I frame it that way is, particularly if we're going to talk about multiples of revenue, the driver of multiples of revenue expanding or contracting in the coming years is a bet about profit margins of firms in the coming years. And so I am someone that remains bullish on small firms and the opportunities for margin on small firms. I know there's a lot of folks out there who are very negative about the small firm environments, but as someone that just loves nerding out on all of the industry benchmarking studies, when I see what I look at over the past 20 years is solo advisory firms continue to get more and more and more and more and more profitable every year. Technology is freaking amazing. What took 3 staff members in 2000 took a staff member and some technology 8 years ago, and now takes a part-time virtual assistant today. And when you start taking your number of hires down from 3 people to a virtual part-timer, and you cut your staffing expenses by 90%, you end out with a more profitable practice. And so because margins are improving in the small firm environment, thanks to the leverage of technology, if we're going to go from solo advisors taking home 60 or 70% of their revenue to taking home 80+% of their revenue, if this trend continues, then even if I'm getting 3 to 4 times my free cash flow or my earnings before owner's comp in a solo firm, if I'm going to go pay 4x that, I could get to 3 times revenue or higher. And I can believe that's creeping up. When I look at the large firm environment, I'm not as optimistic. It's still hard, even as firms go through hundreds of millions and 1 billion and multiple billions, to see much economies of scale. Operational overhead expenses are pretty much like 35%, give or take a point or two, almost everywhere from $500 million to $5 billion. So the economies of scale don't seem to be going up. We talk a lot about fee compression challenges. And if you don't think if you're not finding economies of scale and you're concerned about fee compression, you're not bullish on margins. And if you're not bullish on margins, it's hard to be bullish on valuation multiples. So I don't think it's a doomsday world in large firms. I think some of the fee compression concerns are overstated. If you just look at average revenue yield of firms, it's basically where it is today as it was 6 or 7 years ago when the robo-advisors first showed up. Like, it hasn't gotten better, but it hasn't gotten worse. I think in practice, what we're going to see in the large firm environment is an increasingly wide dispersion of values and valuations on multiples. So if I'm going to buy in a large firm environment for, I don't know, 7 to 9 times free cash flow, maybe David can give numbers for what he's seeing today. You know, when I see firms out there, you know, I see multi-billion-dollar firms that are running 20% margins and multi-billion-dollar firms that are running 35% margins. So both of those firms are going to get an 8+ free cash flow multiple as a multiple of revenue. That means the first firm's not even going to hit 2 times revenue, and the second one could be pushing 3x or more. And that's entirely a function of the fact that advisory firms at the large end are widening out their profit margin. The range is widening because some firms are just flat out run better, priced better, better staff compensation structures, better operational efficiencies than others. And I think you're going to see that showing up in price. So my prediction would be higher valuations at the smaller end and a much wider dispersion of valuations at the large end, because you are really, really, really going to be judged on your ability to effectively manage the profit margin of your firm as a large firm.
Yeah, a couple thoughts from me. I agree with Michael that you know, the smaller firms are not likely to go away. You know, Mark Hurley years ago talked about the mom and pops getting washed away, and unfortunately that hasn't happened. I doubt if it will. It's low barriers to entry. Advisors, big and smaller, adding a ton of value. I mean, the white cowboy hats are the good guys doing the right stuff for the investing public, and I think they will and should continue. I think we'll see consolidation at the top, and I think that'll be an interesting event. We'll see, you know, maybe 15, 20, 25 firms that are mega firms, and it's not just their size, it's that they're running very smart businesses. And I think those folks are going to separate from the pack. They're going to do things differently. Michael's spot on. Technology has had a profound impact, big and small, on the operations of these firms. But no one's used technology much for growth. Some of these bigger players, there's 3 or 4 of them I know specifically that are starting to use technology to drive growth, and I think more will follow. So I think we'll see some game-changing things at the higher end of the market. Those guys are just going to run businesses differently than others. Valuations, you know, we represent sellers, we represent buyers, you know, but at the end of the day, I'm a nerd, you know, we have a 30,000 cell discounted cash flow. It tears these companies apart, it puts it back together again despite, you know, hundreds of factors that influence it. They all fall into 3 categories. One, we've talked a lot about profitability. Profitability matters, less about revenue or AUM. It's profitability that pays back the investor on the investment. You know, margins have been increased in the last couple of years, you know, despite this Armageddon scenario where fee compression is occurring. You know, I've joked I've heard that for 17 years now. I have yet to really see it manifest itself, but I think there's some logic that there's some pressure that's going to occur. So profits are interesting. Growth is going to have a profound effect upon RIAs, and it's both the demonstrated growth and the growth machines, but it's also the risk of competitors. You know, we're going out 10 years, so some interesting things could occur. You know, Goldman Sachs now owns an RIA. Gee, I think of Morgan Stanley just bought E-Trade that happens to be a custodian for RIAs. You know, we might pick other players, turn their battleship, and, you know, become RIAs. And, you know, I think we'd all admit the wirehouses, although I find, you know, many of us might find their models abhorrent, they've done a good job of kind of pretending like they're RIAs. My dad almost thinks he's with an RIA and he's with a wirehouse. And I'm like, Dad, my God, this is what I live and breathe. Come on. But the wirehouses are doing a good job of echoing that model and pretending like they're doing that. So I think that'll be interesting. Perhaps much more, a much greater impact could be, the FANG, Facebook, Amazon, Google. This could happen. This would be a game-changing event if one or many of these players came into the space. So, you want something to wake you up in the middle of the night. I think that, if and when those companies go after this in a big way, I think that will have a hollowing out effect. One could argue the robos aren't affecting the space per se, but they are starting to take these future millionaires and get them under their wing. I think, if one of these dominant players came in a serious way, with the technology they have and just the way these technologies are, that could be pretty fascinating stuff. So, and then you heard my punchline earlier. Mergers and acquisitions, I expect they'll increase potentially even dramatically, but increase and even accelerate over the next 5 to 7+ years.
Yeah, great insights, both of you, and I think hopefully the audience agreed. So we'll let's get to a couple of questions. I know we've had a bunch of them come in. I've tried to kind of curate the best of. I'm going to start with one, and it's from Cameron, and his question is, this is an amazing call. Cameron, we don't disagree. Next one, I'm actually going to direct to you, David. This is one I think is kind of right up your alley, and I've certainly got my opinion on it. It's from Bob, and it's, if, say, 4 or 5 $100 million firms were to come together as one, does it push the multiple up for the whole, or is it better for smaller firms to stay separate? What are your thoughts?
Yeah, so let's see. I mean, a few things. One could argue that's kind of what Focus has done, right? They've taken, 40, 50, 80 firms, and they allow them to exist independently. And clearly there's been an arbitrage opportunity there. But the arbitrage opportunity is private to public. Focus buys these firms at, say 4 or 5 or 6 times cash flow. Now they're going after bigger firms, 5, 7, 8 plus. And then the public markets, historically have supported about a 14 times multiple. So, just 5 firms getting together and acting as 5 different solos with one brand on top, you might find an unsophisticated buyer that's like, great, or, there could be some logic there. You get 5 firms together and you say, hey, we're going to take a 3-year plan and really integrate these organizations and create a $500 million firm rather than, $500 million firms. That's where it gets interesting. But I'd say the brain damage to go through just to sort of cobble together 5 firms and then say, hey, look, we're 500 million is probably a suboptimal approach.
Yeah, okay. That was my thought as well. This one's from just an anonymous question that had come in, and I'm not sure who it's best for. Frankly, maybe both of you will have a perspective on it. And that is, what's available in terms of helping or resources for advisors considering selling or merging? Being a solo is easy and flexible, but I could grow faster and better and make more money while providing better service to clients in a different entity, possibly. So this gets into, sort of the practice management side of things, the mergers, maybe leveraging some of those mega RIAs. Either one of you have a thought or perspective on that one?
Yeah, I'll share a quick thought, and Michael, jump in too. So, yeah, I mean, 40% of our business is doing consulting. We do a lot of valuation work. We do a lot of merger and acquisition work. But, a quarter of our business is consulting. And I think, anyone sitting out there, whether you plan to sell or even not, we coach people, run your business like you plan to sell it. If you run it like you plan to sell it in 3 years, if you don't, you're going to have a more industrial strength firm. You're going to grow faster. You're going to have better profit margins, et cetera. If you do plan to sell in a couple years, this is the right time to pull up the carpet and see if you got hardwood floors, to get that landscaping done, to really clean up your house so that when you put it on the market, you not only get a higher value for it, but you get to live a couple years with a beautiful deck on the back of the house, et cetera. Having that zone of 1 or several years, is the ideal time to, clean up shop. So a lot of our firms, earlier Michael was talking about, some sellers are selling because they're worried that the market decline is going to come. Absolutely true. Folks are like, all right, I can't live for 5 years waiting for margins to come back or valuations to come back. So doing a valuation, like ours, like that diagnostic where you tear your company apart and you start to see the strengths and, capitalize on those things, doing more, the weaknesses, what gaps do we need to close? We have 48 different risk factors we're looking at, growth, we break it into this. You start to figure out, okay, how do I run this like a machine? How do I optimize this? Really put on the COO hat. So I encourage you to do that. You'll create a better organization, not just for your staff, but for your clients.
My take on this question, like, should I stay solo or get bigger so I can, do more stuff, try to serve more clients, serve them better, grow faster, make more money and all that. Honestly, to me, it comes back to what do you actually just want to build in the first place? The highest income advisor we've ever had on our podcast was a solo advisor with $1 billion under management.
Crazy.
Everything was outsourced. He worked on his own. He shared a part-time admin assistant with a buddy for a couple of hours. He makes more than any other $1 billion firm I know. You can do amazing things with the business, from being solo to being big, having partners, not having staff or not. The question ultimately is, what is the vision of the thing that you actually want to build in the first place? High profit solos, and that would take home compensation similar to $1 billion firms. If you look at the metrics that are out there, the single biggest driver of it is the overall affluence of the clients that you work with and the average revenue per client. So, if you want to provide better, awesome service and make more money, target fewer, more affluent clients is pretty much what the math will tell you. If you want to make it bigger, if you want to add staff and add people and grow from there and do more, that should be because you actually have a vision to do that and are excited to do that, because otherwise you are going to be miserable in a business that has to manage people and build infrastructure and scale and do all the things you actually have to do if you want to go down that road. So, if it's income based, I don't know the income goals to this person, but there are folks out there in solo environments literally taking home hundreds of thousands of dollars, $500,000, 700,000, $1 million, more than $1 million as solos by working with affluent clientele. At the end of the day, the bigger the checks they write, the easier it is to be very, very profitable. So if you want to build something beyond that, build it because you want to build that. If you want to make more money with less work, like, I'm not trying to be crass because I love broadening access to financial planning, but fewer, more focused clients that write bigger checks is the pathway to more income. Build a bigger thing because you actually want to build the bigger thing.
Yeah, no, I love that. And we preach this a lot. I've heard you say it before, David, and that is, start with the end in mind. I mean, if you're the next empire builder, fine, build it with that in mind. But if you're running a nice solo shop, you got a good lifestyle practice, and you just keep talking to people who are enterprise builders, and you think, oh, maybe I'll dabble in that space. Maybe I'll try to build something. I'll hire some people. You're not going to enjoy it. So, start with the end in mind and sort of know where you want to end up. I couldn't agree more. We have a couple of more questions we'll run through here real quick, because there's a few really good ones. This one's simple from Tom, and that is, how are you seeing the selling party working job duties, for example, and being compensated for that 3 to 5 year period? So this goes back to the slide I had talked about, deals that we're seeing now that we expect to see in the coming years, where the buyer can just, afford from a free cash flow perspective, in a lot of cases, to keep the seller employed for 2, 3, sometimes 5 years. It kind of ties back into the last comments that we had from Michael and David, and that is, what do you want to be doing? If you're going to sell the firm, well, you're generally trying to offload the stuff that you don't like doing. So what's left? What do you enjoy doing? So the answer really depends on compensation. If you really just love being a rainmaker and bringing in business, you've just always said, if I could just do that, I could kill it, then do just that. And we tend to see arrangements where it's more of a solicitor arrangement or revenue sharing. You might get 40, 50% of first year revenue you refer in. That's your only job. Or Maybe you love managing the money. You've hated talking to clients all these years. If you could just not have to talk to anybody, you'd be fine. Then you take that role and you're more of a salaried role. It's got a cash flow, but it's really kind of dependent on what you want to be doing. Pick that one thing you've always loved doing and do just that. It's good for the buyer, gives them scale. They can ramp you down over 3 to 5 years. They can get their team in place. The next question we had come in, this one actually is directed specifically to you, Michael, and that is, for smaller firms, can Michael elaborate on some of the technology examples, including recommended vendors possibly, that can expand margins like he spoke about?
Frankly, almost any of the common vendors out there can do it. It's much more about standardizing what you do for clients, the process for how you do it. So, I mean, CRM systems, Wealthbox, Redtail, Juncture all work in this space. Financial planning software, you've got Money Guide Pro and eMoney on portfolio accounting tools. You can go for the Orions, Black Diamonds, and Tamaracks, although some advisors I'm seeing in that space, if they're increasingly planning centric, might just use the eMoney portal and not even have a full-on performance reporting engine. What it comes down to that drives those margins is it's fewer focused clients. For most firms I know that struggle with these margins, the problem is not their technology. The problem is that they do everything for everyone and have 172 clients and wouldn't possibly have time to go get more better fit clients because they're drowning in the clients they have. That is, strictly speaking, not a technology problem. That's you have too many clients in an unfocused manner problem. The more that you rigorously focus on who you're going to serve, get clients that all have similar needs, and then create consistent systems about how you're going to serve them, the more that gets focused in. And I'll put a link into the chat here for just a good example of an advisor that does this and runs a very successful high profit practice as a solo by building that way.
Yeah, wonderful. Super helpful. And thanks for sharing the links. Last question I'll ask here, and this one is from Walter, and this is one that I'll give you my perspective on. I'll try to keep it brief because this is one that, David, I know you're going to have some input on. So Walter asks, or starts by saying, size matters, true statement, and multiples. Whichever one you want to use, they tend to index positively. What are some key drivers of higher multiples? What aspects of prospective target firms are buyers willing to pay up for? I'll give you my short version, and I think that is some things we've already touched on. Profitability, systems and processes, growth rate are all important. And again, for me, it also goes back to just some real fundamental evaluation of RIAs. The age of the clients, the number of clients, your revenue per client, just some of those real basic metrics. Those for us are some key value drivers. David, I know you do valuations. You got some opinions on value and valuation trends and drivers. Yeah. What are your thoughts?
No, great stuff. You took through a bunch of key factors that really go into valuations. All those things should be considered, specifically related to size. So on one hand, size matters, and $100 million firms sell for less than $500 million firms that sell less for billion-dollar firms that sell less for $5 or $10 billion firms. So that does exist. Why is that? There's a couple key factors. One is related to risk. So growth, profitability, and risk being the third are really, they encompass all the factors that go into valuation. As you get bigger, there's a higher degree of likelihood that you're mitigating risk with your size. It's not always true. So you want to look at it. But generally, you can imagine you have a $200 million firm and it's 6 people, someone gets mono and suddenly, your firm is in traction. It's like, wow, how are we going to get all this stuff done? You got 25 people, weeks go by and you're like, oh my God, Lisa has mono. She's been gone for weeks. I didn't even know. We should send flowers, make sure she's okay. So it is a people business, and that's a huge factor alone. So you're mitigating that. As you get bigger, we operate differently with 10 people than we did when we had 5 people. You start putting different elements in place. So you become a more industrial strength firm, which also mitigates risk. The other factor that affects it too is as you get bigger, different players are interested in acquiring you. $50 million firm is going to have a certain set of buyers. the major players like Focus or Creative and firms like that, they're going to want to buy billion-dollar firms. Banks are going to want to buy billion-dollar firms. You start having private equity-backed organizations. You start having more competitive environment, and consequently, just the set of buyers will impact it. And the third thing too is there's some firms that they'll acquire a $1 or $2 or $3 billion firm, but also do a $300 million firm. Guess what? When you do a $3 billion firm, you're essentially taking the work that it takes to get one deal done. You're getting like 10 deals worth of activity. So again, there's some upward momentum, but a lot of it boils down to the stability and the institutional strength of the organization.
Yeah, no, that's perfect. And I appreciate just very specific recommendations, because I know obviously Walter asked the question, but there's probably a lot of people that are curious about what are some of the key value drivers, knowing that they've got years, sometimes decades before retirement, starting with the end in mind. And there's another great saying that I love from, I think it's Peter Drucker, and that's, what's measured improves. And I think if you can track your value, or at least think about your value, once a year, you watch, magically things will start to get better just by you keeping it top of mind. So I know we're a few minutes over. We had a lot of great questions, tons of great commentary from David and Michael. No surprise from anybody here. I'd like to thank our esteemed panelists for carving out some time here for us, for the audience. You guys kicked ass as expected. We had a lot of fun. At this point, we're going to button things up here. So thanks everybody for joining us. There are a couple of really good links now, I think, at this point in the chat. So feel free to take a look there. Session was recorded. So if you'd like to go back and rewatch this or reshare it, if you went ahead and registered for the session, certainly if you're logged in today, who I'm talking to, you'll get notifications of this so you can go through and watch the replay. But at this point, David, Michael, thanks so much. Had a great time, a lot of great information. Be well.
Awesome.
Thanks, everybody.